Today we are going to discuss on the scalability and transaction throughput in Bitcoin. Bitcoin, born in 2009 through the vision of Satoshi Nakamoto, is a decentralized digital cash, remains a cornerstone of cryptocurrency landscape in 2025. Yet its scalability, specifically its transaction throughput, capped at around 7 transactions per second, also called as TPS, continues to spark debate. The limitation tied to its block size and the block time shapes economic dynamics like scalability costs, transaction fees, and adoption rates. As of March 2025, with Bitcoin's price hovering nearly all-time high, institutional adoption surging, and global economic uncertainty driving interest, these technical constraints are more relevant than ever. Here's a deep dive into how Bitcoin scalability challenges intersect with its economic role today. Now let's see the Bitcoin's technical core in 2025. It's still 1 MB and 10 Mbps. Bitcoin's blockchain operates at a familiar rhythm. New blocks are added every 10 minutes, each capped at 1 megabytes. This design, unchanged since Nakamoto's era, yields a maximum of 7 transactions per second, far below the thousands handled by modern payment giants like Visa or emerging blockchain rivals. In 2025, the blockchain exceeds 550 gigabytes, reflecting over 16 years of transaction history. Yet its throughputs remain static. This rigidity isn't a flaw but a feature. The 10-minute block time ensures global nodes can sync, preserving decentralization, while 1 MB cap, introduced in 2010, guards against spam and keeps node operation accessible. However, as Bitcoin's user base grows, spanning retail investors, corporations like Tesla, and even nation states like El Salvador, these limits strain its capacity. In 2025, with daily active addresses nearly 1.2 million and transaction volume spiking during market volatility, the 7 transaction per second ceiling is a bottleneck with tangible economic consequences. Now let's look at the scalability cost and how it is in 2025. Scalability costs in 2025 are both technical and economic, amplified by Bitcoin's prominence. Miners, now earning 3.15 BTC per block post 2024 halving, face rising energy prices and global sustainability pushes. Mining hubs like Texas, Kazakhstan, leveraging cheap renewables, still grapple with grid demands as hash rate hits record levels, over 800 exahashes per second. For full nodes, the blockchain size demands robust hardware. A basic node now requires 1 terabyte SSD and high-speed internet, costing hundreds annually. Small operators in developing regions, once Bitcoin's grassroots backbone, struggle to keep up, hunting at creeping centralization. Indirect cost looms large. During Q1 2025, a crypto bull run fueled by US ETF approvals and China's rumored Bitcoin reserve pushed daily transaction demand past 400,000, with only 2,500 transactions fitting per block. The backlog soared. Users faced delays for hours and paid premiums to jump the queue, echoing 2017 fee crisis but on grander scale. The congestion underscored Bitcoin's scalability paradox, its security first design clashes, and its growing economic footprint, raising operational and opportunity cost. Now let's look at the transaction fees. Bitcoin's fee market thrives in 2025, driven by its throughput cap. Miners with the block rewards halved to 3.125 bitcoins lean heavily on fees, now averaging 20 to 30% of their revenue, up from 10% in 2020. During peak demand like February's 2025 market surge, fees spiked to $40 per transaction, dwarfing the $1 lows in bear market. The mempools were unconfirmed transactions weight ballooned to 100 MB, forcing users to bid aggressively. This fee cancellation reshapes Bitcoin's economics. High value transfers like institutional settlement absorbs the cost, reinforcing Bitcoin's digital gold status. But microtransactions, once Nakamoto's dream, falter. A $5 coffee purchase with a $10 fee is absurd, sidelining Bitcoin for everyday use. But that is not what Bitcoin was designed for. It was designed for store of value. In 2025, merchants like Overstock, still accepting BTC, report slower uptake as fees deter customers. Meanwhile, El Salvador's Bitcoin Beach experiments is local, favoring Lightning Network wallet over on-chain payments, highlighting the fee barriers real-world impact. Now let's look at the adoption rates. Adoption in 2025 reflects Bitcoin's throughput tension. On one side, its scarcity, nearing 19.8 million coins mined, drives institutional FOMO. BlackRock's Bitcoin ETF launches 2024 holds 500,000 BTC, while strategy stashes over 500,006 BTCs. Nation states too join in. Rumors will of Russia stockpiling Bitcoin to hedge sanctions. The store of value narrative thrives on limited block space as security trumps scalability for long-term holders. Yet mass adoption as currency stalls. At 7 transactions per second, Bitcoin handles just 604,800 transactions per day, peanuts against Visa's 150 million. In 2025, with 50 million global users, each could make one on-chain transactions every 83 days if evenly spread, an impractical reality. Retail adoption lags. Starbucks retesting BTC payments via Strike cites low confirmation as hurdle. Competing chains like Solana siphon transaction use through their centralization, though their centralization draws skepticism. Bitcoin's capped throughput thus caps its economic reach, locking it to niche despite mainstream buzz. Again, the purpose of the Bitcoin is store of value, not daily transactions. We can use layer 2s like Bitcoin Lightning to increase the speed of increase the usage of Bitcoin usage. Now let us see some of the solutions. The Lightning Network, now mature in 2025, is Bitcoin's scalability lifeline with 40,000 active channels and $500 million in locked value. It processes millions of transactions per second off chain. Think instant 0.01 payment at scale. Adoption grows. El Salvador's Chivo wallet integrates Lightning, and Strike's US rollout sees 2 million users. Businesses like BitRife report 70% of BTC transactions via Lightning, slashing fees to cents. But Lightning isn't perfect. Users must lock funds, manage channel uptime, and navigate hub lanes. Nodes like uh, AsyncQ handle 30% of the traffic, sparkling centralization fears. On-chain fees to open and close a channel also spike during congestion, hitting $50 in early 2025. Still, Lightning economic promise shines. It reversed Bitcoin's cash-like utility, boosting adoption where on-chain fails. Other fixes linger. Bitcoin improvement proposal 119 debated in 2025 as larger block, for example 4 MB, but miners and developers split. Big blocks favor industrial miners, alienating small nodes. Taproot's 2021 upgrade aids efficiency, yet throughput gains are marginal. The community's 2025 discourse aid on X and dev forums weighs decentralization against scale, with no consensus in sight. Bitcoin 7 transactions per second limit ripples through 2025 economy. Scalability cost strains nodes and miners, pushing the economic network towards professionalization. Fees volatile and high. Cement Bitcoin as a settlement layer. Think cross-border deals, not groceries. Adoption splits, hodlers and institutional pile-in. but daily users lean on Lightning or drift to altcoins. Global regulations eyeing Bitcoin's 1.5 trillion market cap, mull energy and fee policies with the EU's 2025 Crypto Green Act targeting proof of work emissions. To conclude, as of March 2025, Bitcoin's scalability challenges is a microcosm of its identity crisis. Its 1 Mbps blocks and 10-minute pace, unchanged in 2009, secure a decentralized fortress but choke transaction flow. Economically, this breeds high cost, a fee driven market, and uneven adoption, testing Nakamoto's vision against modern demands. Lightning offers a bridge, but not a cure. As Bitcoin navigates 2025 bull markets, regulatory scrutiny, and tech evolution, its throughput dilemma will decide if it's a global currency or a glided relic. Technically constrained, economically potent, and perpetually debated.